this video, we want to look at another important topic, another accounting standard. In this video, we want to look at investment property. And when we talk about investment property, its accounting treatment, its provisions are enshrined in the International Accounting Standard 40. So, International Accounting Standard 40 deals with the treatment of investment property. Please, this is Ronas Academy. If you've not subscribed, kindly subscribe. Support us by recommending us to others. Share our lessons with others so that we can have a very wide learning community. So in this lesson, our focus is going to be on investment property. That has to do with IAS 40. It's already on the board. So IAS 40. So I'm going to use initial, which is investment property or property. Okay. So when we talk about international accounting standards, like I have in my other video, how to study accounting standard. Anytime you take an accounting standard, you barely have to look at some hierarchical structure. You have to look at the objective of the standard, the scope of the standard, what is the definition of some terms in the standard, how should we recognize the items in that particular standard, how should it be initially measured, how should it be subsequently measured, and how should it be recognized from the books of the entity. So basically, if you take any accounting standard, you are going to pass it through this hierarchical process or structure to understand the principles and the concept in the standard. So we are going to do the same thing for investment property. Now, the objective of IAS 40, which is investment property, is to prescribe the accounting treatment for investment property. Now, before we look at the definition and the scope, we have a standard that looks at property, plant, and equipment. That has to do with IAS 16. We have an accounting standard that has to do with IAS 16. Investment property is different from IAS 16. So by the end of this particular lesson, you will get to differentiate between the items or the properties that can be classified as investment properties and those that can be classified as property, plant, and equipment. Those that falls under IAS 40 and those that falls under IAS 16. Now we talk about the scope of IAS 40, so I focus on IAS 40. We are basically looking at all investment properties, in exception of biological assets and other mineral rights. They don't fall within this particular scope. When we talk about biological assets, they are being accounted for under IAS 41, so they don't fall within IAS 40. Okay, so that has to do with the scope of IAS 40. Now, what is investment property? What is investment property? Please, the definition of investment property is very, very important because it will aid you in distinguishing which properties cannot be classified or are not investment properties. So the definition that the standard prescribes is very important in distinguishing properties that are investment properties and those that are not investment properties. When we talk about investment property, we are saying that they are properties. And when we talk about property here, we are looking at land and building. Land and building, or part of building, or both. So it can be land or building. So we can have it separately land, we can have it separately building, or we can have it both, or we can have it being part of a building. So part of a building in a situation that we are having a story building, so a part of it can be an investment property, whilst the other may fall under other types of properties. So when we talk about investment property, I'm looking at the definition, the explanation. So we are saying that it's a property which is in the form of a land or a building, which is held by the owner or a lessee as a right of use asset. So is a property which is held by an owner. So we can have the property being owned by someone, or we can also have it being owned by LEC. But if it's being owned by LEC, then we are looking at as a right of use asset. Then the basic reasons for holding such a property is to earn rentals or capital appreciation, or both rentals or capital appreciation. So the basic reason for an entity or for an individual to own an investment property is to earn rentals and capital appreciation, or both of them. So rentals or capital appreciation, or both of them. So I'm taking the definition again. When we talk about investment property, we are saying that it's a property that is held by an owner or LEC, which is a right of use asset. So in the concept of LEC, we are looking at the investment property as a right of use asset, and this is accounted for under IFRS 16 leases. We will look at that particular standard. It's going to be our next standard we will look at, where we will look at the concept, the technicality that goes into leases. Okay, where we look at the lease and then the leases. So we look at that in our subsequent lessons. So here in the form of LEC, when we are looking at the owner, the person being held by the LEC, then we are looking at the right of use asset. And the basic reason for we holding such a property is to earn rentals or capital appreciation, or both of them, rather than we holding that property for the production or supply of goods and services of administrative purposes. So take note, the focus of an investment property is not for the production and supply of goods and services or for administrative purposes. The focus is not for it to be held for sale. It is only, we are only holding such a property for its rental, cash flows, or for its capital appreciation, or the both, rather than holding it for its production, for the production or supply of goods and services, or for its administrative purposes. So take note, this typically distinguishes what investment property is and what is not investment property. So let's look at, having understood the definition, let's look at some examples of investment property. So we are looking at land that is being held for its long-term capital appreciation, but not short-term. So if the land is for a short term, then it doesn't fall under investment property. We are looking at land that we don't have any determined future use for. So if a business is having a land and they don't have any determined, plan to use it, that land is classified as an investment property. If you have a building that your focus is to rent it out, or is to lease it out under operating lease. Please, building that is leased out under finance lease is not an investment property. It is only lease that are leased out under several types of operating lease that be classified as investment property. So investment properties that are leased out under operating lease, they are the only one we refer to as investment property. So if you have a building and you lease it out under operating lease, we can classify that as an investment property. There are some situations where we will have a building and a land where one part or a portion of the building is an investment property and a portion is not an investment property. So anytime we hold the asset, okay, for the production of goods and services and for administrative purposes, then we are going straight to IAS 16, which is PPE. It doesn't fall under IAS 40. And if you hold that property for sale in the shortest possible time, we want to sell it within the ordinary course of business. We are selling the assets within the ordinary course of business. And then we are going to IFRS 5, non-current asset held for sale. It does not also come to investment property. So anytime you have a building that's a portion can be used, can be occupied by the owner, we call them owner occupied property. And then a portion can also be classified as investment property. The standard prescribes that we separate them and treat the parts that meet the recognition to be recognized as an investment property. We treat it under IAS 40, and then the other portion will be treated under the other standard. By a situation where we cannot significantly distinguish between the portions that belongs to investment property and the portion that is another standard, the standard says that we treat such a property as investment property if the other portion is insignificant. That is, the owner occupied portion is insignificant. In other words, if the IAS 16 portion is insignificant, then we treat the whole property as investment property. So take note of this classification. Okay, so I'm reiterating that. I'm saying that there are some times that a building can be used for either investment property or owner occupied property. That means it is being accounted for under IAS 16 PP. A situation where we cannot classify them, then the standard says that we should go ahead and treat that property as an investment property only when the other owner occupied property portion is insignificant. As simple as that. So that is the definition of investment property, and all those things I've mentioned earlier are the examples or are the types of investment property. Now let's look at recognition of investment property. When can we recognize investment property? Recognition of investment property. The standard says that we should recognize investment property when two conditions are met. So until these two conditions or criteria are met, we don't classify or we don't recognize such items as investment property. One, when it is probable that the future economic benefits that is attributable to the asset will flow to the entity. It is probable that the future economic benefit that is attributable to the investment property will flow to the entity. That is one. Then the second one is that the costs of investment property can be reliably measured. When these two conditions are present, that is only when we can recognize an item to be an investment property. Notwithstanding, the conceptual framework also gives its general recognition criteria. That is meeting the definition of assets and liabilities, equity, and then expense or more than an income. So that is the element of financial statement. So as the general recognition criteria, the item has met the definition of the element of financial statement and also meet other general recognition criteria. But when it comes to this particular standard, we are looking at two recognition criteria, which has to do with the probability that the future economic benefit that is embedded in the asset will flow to the entity, and that the cost that is attributable to the investment property, we can reliably measure it. Until these two conditions are present, because they are mutually exclusive, even if one is violated, we don't classify it as an investment property. So once all these are present, then we can go ahead and classify and recognize an item in the books of the entity as an investment property. Having understood the meaning of investment property, the types, and how and when it should be recognized, we now have to look at what value should be placed on an investment property when it is initially recognized. So assuming today that you have recognized that you are building, okay, another example of investment property is that you are building or you are constructing a building for the purpose of renting it out or leasing it out under operating lease. It's also classified as investment property. So let's say you are constructing a building and you are done and it has met the recognition criteria. What value will you place on it? That is what we are going to look at. That is the measurement. We have the initial measurement and subsequent measurement. When we talk about initial measurement, we are looking at the initial, when you brought the asset into the business, when you construct it at its initial state, what value should you place on it? Now, this asset will be in the business till the accounting period ends. So if the accounting period ends, what value are you going to place on it? That has to do with subsequent measurement. So let's look at how to determine the initial measurement of an investment property. All right, so we want to look at the initial measurement of investment property. Now, the standard indicated that an item of investment property should be initially measured at cost. And this is not different from what we look at under IAS 16 when you want to initially determine an item of property, plant and equipment is initially measured at cost. And this cost here is the same cost we are looking at. But as a means of recap, when we talk about the cost here, we are saying that it is classified under this place to be under two things. We are looking at the purchase in terms of when you are acquiring the property. If you are buying the property, then it's going to be the purchase price. When you take into consideration some items that needs to be adjusted on the purchase price. So here we can have the purchase price, and then we take away any trade discount. We also less any taxes, which is in the form of tax rebates. Okay, but don't forget we are going to add any non-refundable taxes, any import duties. We will add them. You add them to the purchase price. Whilst we less tax rebates, subsidies, we less those ones. So they are the items we adjust on the purchase price. And any other directly related cost or any other cost that is directly attributable to the investment property. This is in the case of when you are acquiring the investment property. So there are sometimes you can construct the investment property yourself, or the entity can construct its investment property itself. So if you are buying, then it's going to be purchase price, which is net of trade discount. Then we add a non-refundable tax. That non-refundable tax. So it means if it is a refundable tax, we are going to ignore. If it is a non-refundable tax, it has its own complications, of which I have looked at it under IAS 16. So you can watch videos on IAS 16 to appreciate the understanding of non-refundable tax when you are determining the cost of an PPE initially. Then we are saying that any directly related cost, which has to do with architect fees, professional fees, installation fees, but mind you, any general expenses are not captured. General expenses or employee training are not included in the initial cost of an investment property. In a case where you are constructing the investment property, then we are going to look at the direct cost. That has to do with direct material cost, direct labor cost, and then direct expenses. And in fact, sometimes you also have to look at borrowing costs. If you are borrowing to finance the construction of the asset, you have to capture borrowing cost. And we have looked at it. Borrowing cost is governed under IAS 16. IAS 23. So borrowing cost is governed under IAS 23. So you can watch our lesson on that one to understand what is borrowing cost. So if there is any borrowing cost, you took loan to construct the investment property, then you have to capitalize that interest on the loan you've taken. That is all about borrowing costs. Then also, don't forget that we have administrative expenses, general overheads, all those expenses that we cannot directly relate them to the purchasing or constructing of an investment property are not captured in the initial measurement. Currently, there was a revision in IAS 16 which states that anytime you are initially testing for the assets, and then you produce some items. If it's a loss, you don't even treat it at all because it becomes an expense in the POL account. And you produce an item that has a sale value. Previously, those sales value less the testing cost. We take away from the testing cost, but we add the testing cost. We capitalize the testing cost, but we take away the value of the initial goods we've produced. Now, the standard has indicated that those sales value, those items that has a sale value should be treated as an income in the profit or loss account. We don't take it away from the testing cost. So those things are having captured under IAS 16. So you can look at that and then appreciate that particular concept. So initially, when we are talking about initial measurement of investment property, don't forget, is initially measured at what? At cost. And we have looked at what constitutes costs. The meaning of cost is not that relevant here, but we talk about cost. We are looking at the amount that the entity paid to acquire or construct a particular asset, or the asset given out for the fair value of an asset given out to acquire another asset. Is that okay? All right. Now there are some circumstances where an entity will give out an old assets to acquire a new one. So here we are looking at exchange of assets. If there is an exchange of assets, how do we determine the initial value of our assets? So let's say that there is an asset A which is being replaced by the entity's asset B. So this is what the entity is having. This is old, okay, and this is new coming in. So there is an exchange of an asset. How do we determine the value of the new one? The standard prescribes that we use the fair values of the asset being exchanged. We value the asset at their fair value, unless there are some exceptions. When the transaction lack commercial substance and the two assets, we cannot determine their fair value, then we cannot use their fair values. So if the transaction is lacking commercial substance, their coming in will not have any effect on the risk, the timing, and the amount of the cash flows of the entity. It will not affect them. There is configuration. If there is a configuration, that has to do with there is a commercial substance. So lack of commercial substance means that there is no configuration. The risk, the timing, and the amount will not have any effect on our cash flows. It will not have any effect on our financial statement. Then we are saying that that particular transaction lacks commercial substance. And also, if we cannot determine the fair values of the two, then we cannot determine the value. Then standard prescribe that the carrying amount of the old vehicle become the value of the new one. But when we can determine their fair values, then the fair value of the asset becomes the value of the new asset. So that is it with this one. Remember that any subsequent expenditure which does not change substantial portion of the asset is treated as an expense. It's not capitalized. It's treated as an expense. However, if there is a major change in the particular investment property, and that major change will increase the useful life or will enhance the economic benefits in the useful life, then such costs are supposed to be what? Are supposed to be capitalized. Don't forget, you may also consider dismantling costs. Taking into consideration it. Dismantling cost is a future cost. So if we are having any effective interest rate in the question, you barely or you probably have to discount the future cost to present before you can capitalize it as part of the cost of the asset. So that is it for initial measurement of an investment property. Okay, so we want to look at the subsequent measurement of an investment property. Subsequent measurement of an investment property. Now, subsequent measurement of an investment property, the entity is allowed to select two models or two approaches in subsequently measuring an investment property. So the entity is allowed to either use what we call the fair value model or what we call the cost model to subsequently measure its investment property. So an entity can choose a fair value model or the cost model. Once you've selected a particular fair value model for a class of an investment property, then because of comparability and then relevance, you have to continue to apply the fair value model to such or to similar types of what investment property, unless otherwise you want to apply IAS, which has to do with policies, changing estimates, and then errors. If you want to do that, you are also allowed by taking into consideration the provisions in IAS 8. Now, an entity can choose the fair value model or choose the cost model in subsequently measuring an investment property. So now we now want to go into how to subsequently deal with an investment property that is measured at fair value. Now, anytime an investment property is subsequently measured at fair value, then it means that there must be an active market for that particular investment property for you to determine the fair value. So you should be able to determine the fair value. So let's say we have year 1, you need to determine the fair value here. Year 2, you need to determine the fair value here. So we can have the opening and then the closing. Now, the treatment is that any fair value gain or loss on an investment property should be treated in your profit or loss account. Profit or loss account. Any profit, any gain or loss on an fair value, or we call it any fair value gain or loss, should be treated in your profit or loss account. What do you mean by gain or loss? Assuming that you initially measured your investment property to be at a cost of $15,000. This is at the initial measurement. Then at the end of the period, the fair value of this investment property is now $16,500. So it has increased. The initial measurement, there's a difference between the initial and then the closing. So here there is a gain of $1,500. This $1,500 should be treated as a gain in the profit or loss account. On the other hand, if you have the fair value lesser than the initial measurement, then it is going to be a loss. Now, if you come to year 2, this becomes the opening value of the investment property in year 2. Then the closing fair value will also be determined. So let's assume that the closing fair value is now 15,400. 15,400. Now you are comparing with the opening of 16,400. So you can see that there is a loss over here. There's a reduction in the price. So that loss will also go to your profit or loss account. So this actually differentiates when it is an owner-occupied property. When it is an owner-occupied property, we deal with revaluation. We deal with revaluation of the assets. If it's a PPE, we deal with revaluation. If it's an investment property, we deal with what? The fair value model. So they can ask you, what is the difference between fair value model and the revaluation model? You can even look at the treatment here. You see whether there is a gain or a loss on fair value, it all goes to profit or loss. When it comes to revaluation, a revaluation surplus goes to the other comprehensive income, and revaluation loss generally goes to the profit or loss account if there is no previously recognized revaluation surplus on that particular asset. So there are exceptions there. So you can see the treatment. The treatment alone is giving you a clue that there are differences between fair value model and the revaluation model because of their treatment. And fair value model is for investment property, whilst revaluation model goes with owner occupied or property, plant and equipment. Okay. So this is when we are dealing with the fair value model. Now remember that this is barely the comparison of opening and closing fair values to determine whether there's a gain or loss. And then the treatment is we are sending it to the profit or loss account. So do not forget about that. Now take note. If you really want to pass all your standard questions or your IFRS financial reporting, corporate reporting courses, you barely have to take into consideration exceptions in the standard. Most questions are framed around the exceptions in the standard. So let's look at this one exception under the fair value model. Now, this exception says that there is a rebuttable presumption. There is a rebuttable presumption. And when we talk about rebuttable presumption, when we talk about rebuttable presumption, we are basically looking at laws that they are exceptions or laws that we can make inferences to, or we hold them to be reasonable truth until they are proven otherwise. So we can hold them to be something that is backed by laws that we accept to be true until they are proven not to be true. So there is a rebuttable presumption that an entity can always determine the fair value of an investment property. That is the rebuttable presumption. Always the entity can determine the fair value of an investment property. But the exception is that there are some times where the investment property or the property in question we cannot have it observed, observable price in the market. It doesn't have any particular transactions in the market for which we can determine its fair value. When that happens, the standard says that the standard prescribe how it should be treated. Now, the standard differentiates an asset that is under construction and other assets. if we cannot determine the fair value of an asset that is under construction, the standard prescribes that we treat or we account for that particular construction investment property as at its cost. So we will use the cost that we incurred in constructing that particular investment property as its cost if we cannot determine its fair value until the date that it will be completed. Once it's completed, probably we can determine what the fair value, then we start applying the fair value. That is with construction of the investment property which does not have its fair value. So during the construction process, we have to use the cost as the value of the construction as the construction goes on. Okay, and then when the construction is completed on the property, then we can now ascertain the fair value and now apply it on that particular asset. The other assets that are not under construction, then the standard says that we should continue to apply their carried amount. We should hold them at their carried amount, or we should use what we call, we have to use the cost model. We should apply the carried amount of the asset. So it will be measured at their carried amount subsequently, and then you are going to apply the cost model. This is with fair value model. Remember that anytime an entity is having an investment property, the entity is allowed to choose the fair value model or the cost model, looking at the one that will give the entity more faithful information. So that we look at how to do with the fair value model. Now let's look at how to do with the cost model. With this one, I'm not going to spend much time. The cost model, we've already looked at it under IAS system. When we talk about the cost model, it is when we hold the asset at its cost. So when we talk about the cost model, we are saying that the asset is at its cost minus the accumulated depreciation minus accumulated impairment loss. Impairment, that is when we are looking at cost model. So subsequently it will be depreciated. Please, if the asset is hold or we are using the fair value model, we don't depreciate it. We don't depreciate the asset. Okay. Now the standard prescribes that under the cost model, you have to look at the kind of cost model we are looking at. So if the asset is falling under investment property, then we are going to apply IAS 40. If it's going to be property, plant and equipment, then we are going to apply IAS 16. And if it's going to be held for sale, then we are going to apply IFRS 5. IFRS 5. We are looking at the cost model. That means subsequently we are going to depreciate it. Then we are going to apply what we already know under IAS 16. If it's going to be held for sale, then we apply IFRS 5. If it is under an operating lease, then we are going to apply what we call IFRS 16, which has to do with leases. This is for the cost model. All right. Now let's look at transfer. There are some times where an investment property can be transferred to an owner-occupied property or property, plant and equipment. Or there are some times where the owner-occupied property or property, plant and equipment will also be converted or transferred towards investment property. How do we measure the investment property when there's a change? Remember that for us to say that there's a change, that means it is either violating or is meeting the recognition criteria of investment property. For us to say that there's a change in the use of an investment property. So for us to say that there's a change in the use of an investment property, then it is either meeting or it is either violating the recognition criteria for investment property. You have to know that. If management are just using their own judgment to say that there is a change in the use of an investment property, the standard says that we don't consider that as an evidence of change in the use of an investment property. We don't consider that until it is being initiated. There is an development of it. If there's no development of it, just using management judgment, the standard says that we don't use such as an evidence as a means of change in investment property. Now let's look at how to account for when there's a change. See, when there's a change from, so let's say investment property to owner occupied property. Sometimes we refer to it as PPE. Okay, so but here when they are measured at fair value, okay, so we are using when they are measured at the fair value, or when the entity is using the fair value model. So the entity, this investment property is measured at fair value. It's measured at fair value, and it will change from its investment property to owner occupied property. That means now the asset is not being held to earn rentals or for capital appreciation, but rather it's going to be used for the production of goods or services or for administrative purposes, or is even being going to be held for sale. If that's the case, the standard says that, and the entity is already using the fair value model, then the initial amount of this owner occupied property will be the fair value, be the fair value of the asset, be the fair value of the asset. Then if it is being changed from owner occupied to investment property, then the standard says that we will continue to use the method we were using to account for the owner occupied property up to the date of the change, or up to the date of the transfer. So assuming the date of the transfer is 31st of December 2020, then we will account for that particular item using either the cost model or the revaluation model up to this particular date. So here you know that even if it's revaluation model, we still depreciate, we subsequently depreciate revalued figures. So you have to account for it, and then you come here and then you now compare the fair value with the carried amount as at this date. Any gain or loss or any differences between the fair value of the asset and the carried amount will be treated in the profit or loss account or other comprehensive income, depending on how the asset is valued here. So assuming that the asset was revalued, the entity used to use the revaluation model here and is now being converted into investment property, then we determine the revalued figure at the date, and there is what a fair value. This value is bigger. We are this one is, let's say this one is $1,000, and this is two, this is $800. Then there's a change, there's an increase here, 200. This 200 will be treated as a gain in the other comprehensive income because this asset was previously what revalued. But you have to also consider if it was if it has been impaired before, if the asset has impaired before. If it was impaired before, then we are supposed to take it to the proportion in the profit or loss account. So such treatments are already under IAS 16 if you look at that. Okay, so when there is a loss, you can get a loss on a revalued figure, and there's a gain now. You first have to go and negate that loss before the rest will be sent to your other comprehensive income. Again, if it's a cost model, we apply the same thing. If it's a loss, it goes to the profit or loss account if there were no previously recognized evaluations of loss on that particular asset. So this is a case when we are changing from investment property to owner occupied property, and the entity uses the fair value model. Assuming the entity uses the cost model, then the standard says that the initial value of the asset becomes the carried amount. So after you have depreciated, unless you accumulated depreciation, the carried amount of the asset, either you are transferring from investment property, owner occupied property, or from owner occupied property to investment property, you have to use the carried amount of the assets. So the next thing to look at is presentation. When you look at presentation, remember that we have to account for the assets as a separate line item in the statement of financial position. So if you go to the statement of financial position, you have to see investment property over there with its fair value or its carried amount as at the date of the account. Okay, and then we have to account for the changes, which is the fair value, gain or loss in the profit or loss account. That is the presentation. Then don't forget also about the issues of revaluation of loss when we are changing. Then remember that will go to other comprehensive income if there were any gain as a result of changing from owner occupied property to investment property, and there's a gain. All right, and also we have to look at disclosure. Disclosure is very important, and I always say that if you want to disclose something in a particular standard, always look at what goes into the standard. So here, if you want to look at the disclosure requirement, we are looking at, is the entity using the cost model or the fair value model? When was the asset even bought? Does the asset even meet the recognition criteria to be classified or recognized as an investment property? You look at all those things that goes into the standard. They are what they are what you are supposed to disclose. So basically, this is investment property. You have to take note of the critical things, the exceptions, the meaning of investment property when we can say that this particular item needs to be called an investment property and when they are not supposed to be called as investment property and the rest. So you probably may take a question, a practical question, and look at how to go about them. Thank you, and we appreciate you for always learning with us and sharing our lesson with others so that we can expand our learning community. We thank you. We appreciate you. If you have any question, you can leave it at the comment section. If you want any particular video on a particular topic or standard, don't forget to leave it at the comment section and we will attend to you in due time. Thank you.